We have Mark Hamilton with Hamilton Zanze, and you can find them and their contact information and a bunch of resources on their website. So head over to Hamilton Zanze, that's ZANZE.com, in order to get some more information here. But Mark has been in this business way longer than I have. So this is going to be a great conversation. He's been in the business now for 20 years. He holds $4.3 billion in specializing in multifamily investing. But I think we're going to especially spend some time on the value of 1031 exchanges. So I really appreciate your time here, Mark, and really looking forward to learning from your 20 years plus experience.
Well, Jack, I appreciate it. And I appreciate you inviting me to be on your show today. And notwithstanding the kind reference to 20 years, it's actually much worse than that. I've been in the business for 41 years.
Holy cow.
Yeah. This is my 21st year of being partners with Tony Zanze. We started in 2001, and we were both mid-career. At that point, we weren't old dogs then, but we are old dogs now. And we've had a really good run, done some good things for ourselves and the people in the organization and a lot of clients.
Yeah. Wow. 40 years in the business. What you know now, do you wish you knew back then?
That's a really interesting question. We all have a common fantasy that if we could only travel back in the past to a certain day, then we'd have the winning lottery numbers and we could buy that lottery ticket and our lives would be different. I've had anybody that's my age has had some ups and downs, and real estate can at times be a little bit like riding the tiger. But I wouldn't. I wouldn't go back. It's been really good for me. I know something different every year, if not more often than every year. And certainly your perspective evolves as you age or old. But yeah, no, I wouldn't go back. If I knew then what I know now, things would be different. But every day is its own day, and the things that come along, and I'm just really delighted and grateful for the life that I have, and I don't think I would change any of it.
Well, I'm just really curious, just because we could spend, I'm sure, an entire episode just talking about how you got into real estate investing, but I'm sure everybody has asked you those type of questions in the past. In fact, if you'd like to know more Mark's background, I'd have you direct you to his website. I'm actually more curious, really, as I have a lot of real estate investors who are just getting into the business. That's why they listen to these podcasts.
Right.
Is there one thing that you wish you would have known, or right when you got started?
I'll answer the question slightly differently. I'm gonna kind of try to choose a point in between your two questions, and I'll just reflect back on an episode back in the RTC years, which were the late 80s and early 90s. There was a lot of reckless lending, savings and loan lending primarily, that had taken place during that time. And it turned into a big mess. And the federal government basically swooped in and cleared the decks. And they cleared the decks by shuttering insolvent savings and loans and taking over their balance sheets, taking over their assets and their liabilities. And they were not set up, and they knew it, to own real estate. And so it may not have been quite a fire sale. There was a lot of property that got put back on the market that got deleveraged and went down in value when it got taken by the federal government by the Resolution Trust Corp, which is RTC. And that was a really good time to buy. Sam Zell bought hard and probably long during those years. There were good assets that just couldn't live with the amount of financing that they had on them, and it dragged those institutions down. So, it would have been fun to be a little further along in my career at that point, so that I could really get my arms around some of the RTC stuff. And, I went to a meeting with a banker who's a fellow I still know. And he said, you should just be buying trust deeds, buying loans before they default. And that just sounded like the last thing in the world I thought I should do. I wouldn't have known how to do it. I wouldn't have felt confident that I knew how to get through the foreclosure proceedings and all that kind of stuff. So, you do have to stick your neck out a little bit. You have to really, I guess it comes down to three things. You have to like the work. You have to be willing to do the work thoroughly every day. And there are times when you're really going to have to work hard. And you also have to look for opportunities to think outside the box. And that was, if I had known more about what it meant to buy, to just basically buy loans, at that point, it probably would have been different. But we've always been solidly on the side of being equity investors. We pool equity, we contribute our own equity, and very generally it goes into partnerships that we form, and then we go in and we buy the assets with that equity and obtain new conventional debt. So we're fairly mainstream in terms of our equity and financing strategies, but I do think you have to know how to look outside the box, and you have to be willing to look outside the box. And there are certainly things that we look for now that I wouldn't have known to look for 20 or 30 or 35 years ago.
Sure. Well, could you give us an example? Like, what are you looking for now where you wouldn't have before?
Well, buying loans would be one thing. And to this day, we don't do that. But when Hamilton Zanze started, it was me and Tony and one other person. The first property we bought was a 16-unit building in an up-and-coming part of Oakland, California. And this was right after 9/11, and we bought it for $1,150,000, and we're happy to get started. And then the next year was bigger, and the following year was bigger, and so on. But we've kept our eyes open to different operating platforms. And after about 10 years, we put together our own property management company. After 7 years, we made our first office building investment, and then eventually grew that into a platform. After about 15 years, we put together our own commercial property management company. And then there are some other smaller organizations that we've put together. So being open-minded about opportunities and platforms is certainly something you have to do. But also last year in December, after working on it for probably 9 months, we closed the acquisition of a very large portfolio in the Bay Area that had gone into bankruptcy, and it was a real chore. I mostly played consigliere and sounding board. The team worked really hard, and we bought 39 apartment communities and 21 suburban office buildings, and that's something we just wouldn't have even dreamed of 5 years ago. 5 years ago, we started a DST, Delaware Statutory Trust initiative, to go alongside our other 1031 businesses. We've formed our own captive insurance company. We've done 10 small funds, and we just did our first discretionary fund that was larger, materially larger than any of the others before. And so you have to be open-minded to doing new things. And, once upon a time, I was the tip of the spear in terms of doing new things in my own little way. And that, the invention that goes on in our office, for the most part these days, is driven by other senior members of the team. So,
it sounds like you're spurring off a lot of other businesses out of your core business. You talked about not only collecting these assets, but you have the property management, commercial property management. You mentioned insurance. You're buying paper. Were these all out of you saw a need and you were just trying to fill those gaps, or were these like you specifically, like you mentioned, you saw the opportunity and you took it?
It's the second. Yeah, we really saw the opportunity. I mean, everything in this business, if you're an investor, is driven by an opportunity that presents itself that suits the investment objectives of an investor at that point in time. There are lots of people that buy triple net, long-term, single tenant properties. The returns on that are usually going to be more pedestrian, but it suits a need, right? There are people who buy land and build. It's not going to be pedestrian at all. And the returns are going to be, at least prospectively, material, very significant, but you take more risk, right? So real estate investors come in different shapes and sizes. They buy land, they build, they do subdivisions, they buy triple net retail. They buy apartments, they buy mobile home parks, they buy shopping centers, they buy industrial, they buy office, they buy high rises, they buy suburban. And so the temperament and the basic objectives are going to run with the investor. But every investor is going to have an opportunity that they're looking for. And it may be as modest as getting a 3 or 4% return for 20 years, but having security, having a high credit tenant, like a bank or a McDonald's or a Walgreens, and they're willing to accept a more modest distributable cash flow, but they may want it for estate purposes. They may want it for continuity of income purposes. They may want it for completing a tax-deferred exchange. So I do think it all comes back to opportunity. There are some people who are inventive, despite the ups and downs. Some would look at WeWork, for example, which went out and leased just mountains of space nationwide. And I mean, you could pretty clearly tell that by looking at their strategy, they were looking for a need, and they had an idea of a need that they could fill in the universe. And, despite the turbulence, they did fill a need. But I think by and large, people who are professional real estate investors are looking for an opportunity.
Sure. Well, this kind of leads me to my next questions is that, you mentioned that a lot of people start off in those single family homes. And frankly, a lot of what you're doing, it's taking you 40-year career. It doesn't sound like this portfolio has been accumulated in over the past 20, but it's almost more aspirational. They see it almost as a big monopoly game. You buy a bunch of single family homes and then you trade them in to get that multifamily. Do you think that is the right strategy for a lot of people, or should they consider just jumping right into multifamily investing?
That's a really great question. And again, it's going to come back to the person. There are lots of ways to invest in real estate. You can buy a home, you're a real estate investor. You can buy a home that you want to renovate and sell and then do a 1031 exchange. You can buy, these days, a common strategy is buying high-end condos and then putting them into Airbnb pools. So there's many different ways that you can start investing. If you want to buy a small apartment building with a friend who's a carpenter or a plumber or a CPA or what have you, and have a plan for that investment, you can certainly do it. I would say that the first thing to do is to have a sense of your long-term goals and to have a sense of the amount of patience that you have. The first property that I bought, my wife and I bought a property in San Francisco in 1985, in a part of town that was pretty rough. It had been much rougher before we bought this property. This property was close to being a fright. The first time my mother-in-law saw it, she broke into tears because it was going to need a lot of work. And I was probably naive, but it worked out. And we worked hard. My wife and I did a lot of the work ourselves, nights and weekends. But we caught the bug, right? And kind of, once you've been bitten by the bug, it's hard to leave it behind. But 2 units, and then my boss at the time saw what we were doing, and was interested in it, and it kind of sponsoring us as an angel investor. And then we went out and bought a 3-unit building, a 3-unit building, and a 4-unit building, and those had good outcomes. Back then, San Francisco was still kind of rugged. It hadn't become the San Francisco it was decades away from the San Francisco of Facebook, and Genentech and Apple. It was rugged. But we became partners with another married couple from her hometown who were doing the same thing here. We threw our lot in together and formed a small company, and we're just really working hard doing transactions. And so slowly climbing the mountain. You have to know if you're going to do this, you need to be able to spend a lot of time and have an income at the same time. And we were able to make income and still do it because there was opportunity there. A lot of the opportunities have gone by. It's harder to get into the market now. The prospective returns are going to be lower because it's just so competitive. There's so much capital out there. And I think there's fewer, almost every stone gets turned over every day. So there's fewer there's less low-hanging fruit than there used to be, and there's an ocean of capital out there competing for it. But I think if you're a patient investor and you want to harness a 1031 exchange, you can invest in an asset any number of ways. You can buy a REIT stock. The REITs certainly use the 1031 as they see fit. You can buy, and that can be publicly traded or private REIT stock. You can go into a small syndication or partnership with other people, perhaps as few as one or two other people, but you can also throw your lot in with other professional investors such as we are. And, you just have to be, I think at this point in time, one of the things that's called for in addition to hard work is patience. When Tony and I became partners, after our first 5 or 6 years, we could see that we were holding assets for about 3.5 years. I think our average hold back then was about 42 months. So you raise the capital, you go and you make the acquisition, you do the asset management, the project management, you do the heavy lifting, put it back on the market and sell it and go look for your next opportunity. Well, if you took let's just say that was kind of the time cycle of the investments we made in the first 5 years. If you take the time, if you look at a time cycle for the properties we've acquired in the last 5 years, the arc of ownership or the period of ownership will probably be much longer on those. It'll be 7 to 10 years for sure. We do have assets that we really like that we've kept for 10 or 15 years. But I think shorter time horizons or shorter durations of ownership were certainly propelled in part by falling interest rates. And I don't know where interest rates have to go, but up from here. So we're not going to get that, we're not going to get the same kind of cap rate compression going forward that we've seen over the last 20 years. And again, there's a huge amount of capital out there. But if you can buy something or invest in something that's going to be profitable, that's going to pay you some return as you go, that has every good reason, that has every good justification for being profitable, and you're going to enjoy the benefit of a 6 to 8 year ride, and you're young and can turn that over a number of times during your remaining investment years, you have an opportunity to grow that capital and defer the taxes on it for as much as 30 or 40 years.
So, well, you can actually, if you go to your website, and I'm going to point everybody there again, hamiltonzanze.com. And I'm going to, like I said, it'll be in the show notes, but you can actually see a lot of what you're talking about, the roots of your history, because you're still looking for value added. You have a value added approach to your multifamily investing today, right?
You bet. And to our suburban office as well. And, the biggest engine, the biggest driver in our business has always been value add. But I have some partnerships that are still ongoing after 30 years. And any one of those is probably owned on a 30-year partnership. That partnership has probably been invested in at least 5 or 6 different transactions. And it's been, and when we've moved, when we've sold and then repurchased, we've been able to defer the capital gains for the investors by doing a new acquisition. And we have, my history goes back before Tony and I became partners, and a lot of those old partnerships are still in our system. So, you have to have somebody who's going to mind the store. And there's a lot of care and feeding that goes into apartments. One of the old adages about apartments is the 3 T's, which are toilets, trash, and tenants. And that's shorthand for just saying there's going to be a lot of work to do. But you have to have somebody who's going to be able to mind the store and put in the care and feeding and allow you to still have an income to support yourself. So, unless you can do it while you're moonlighting, or unless you have a spouse that is content to be the primary breadwinner, it's probably going to be hard to give up your salary and do this unless you're already pretty, of independent means. Well,
let's go to the 1031 exchange then, because I know that you kind of specialize in that a little bit, and how you can, and the syndication and the partnerships that you take advantage of here to continue to accumulate your portfolio. So, we use the term 1031 exchange quite a bit, but Would you mind taking a moment to just kind of explain to people what it is and maybe the tax benefits associated with it?
Of course. If an investor buys a property or an investment group buys a property for $1 million and they pool, let's say they pool $300,000 of capital and obtain financing of $700,000, and their financing package, their financial resources allow them the funds to work on a property and add value and increase some value. And then they sell that. Let's say they sell that 5 years later for $1.5 million, at least $1.5 million net. Maybe they sell it for $1.6 million and then have commissions and costs of sale and the like to bring it down to $1.5 million. By 5 years, your loan is probably amortized. It's probably amortized down some. Maybe instead of $700,000, it's $675,000. And your basis, the investment basis that an investor has, is the $250,000 the $300,000 of capital that was invested, adjusted for depreciation and distributions. But let's hold depreciation and distributions out of it for a moment and just assume it's in a vacuum, that you invested $300,000 in cash, you took out a $700,000 a sale event, and you come out with proceeds of $1.5 million, and you retire your financing of $675,000, and then you have $825,000 in proceeds that can be distributed from your closer or your title company, depending on how they do it in your state. If you direct the closer or title company to send those funds to an exchange accommodator, and again, we're for the moment we're pretending it's $825,000. Then the exchange accommodator can sit on that money. You're not allowed to take what's called constructive receipt of the funds. That if you have that money sent to you, you will not be able to do a 1031. You'll be determined to have sold the property rather than exchanged it, and you'll be taxed. At capital gains rate and recapture. But if you domicile those funds, the 825 with an exchange accommodator, then you have 45 days from the time that you sold they call it relinquished property. In shorthand, we call it the down leg. You have 45 days from the time you close your sale to locate generally speaking, 1 to 3 properties that you would content yourself to purchase. And then you do what's called designate. And designating is completing a form that your exchange accommodator will provide you, and you list the particulars of the properties that you're looking at. And so within 45 days, you basically constructively told the IRS, I'm completing my designation by designating these 3 properties. And then from there, you have 135 days to close a purchase on one of those 3 properties. And your mandate, for the sake of a full deferral of capital gains taxes, is to reinvest all of your proceeds, in this case, $825,000, and you can add cash to that, but it's $825,000 or more, and to replace your financing, which was $675,000 or more. And it's not uncommon for people to upsize both of those amounts. You might well, if it's a partnership, you might well have the wherewithal to invest $1 million, to top off your 825 with another $175,000 and have $1 million of capital to reinvest. And then it's also very common for people to upsize their debt. So you might go in 2 steps, basically, or 2.5 steps. You might go from $300,000 in capital, $700,000 in financing, purchase a property for $1 million, sell it for $1.5 million, reinvest the proceeds, secure new financing, upsize them both, and discover that now you've bought a $3 million asset. That kind of footwork is not unusual. The math of every exchange is going to be different, but generally it's an opportunity to take whatever the sum of capital is that one or more investors have, invest it, make it produce an event, use financing as you see fit. We always believe that it's best to use intermediate leverage. We're not believers in severe leverage, and we're not believers in under leverage. But 65 to 70% leverage is a good spot to land. And after 2 or 3 successful cycles, you might be sitting on one or more buildings that are now worth $5 to $6 million. It's not going to happen in a few years, but it could happen in 10. And all that prospective capital gain will be deferred. Different states have different capital gains rates. I believe the federal capital gains rate for long-term gains is 20%, but then the IRS will also charge you for what's called recapture, which is depreciation. You've been using the depreciation to shelter your income and defer the gain on that. And then when you liquidate, you have to pay the government back for the benefits of the tax shelter that you've gotten. So it's quite efficient. It's a viable long-term strategy. And it can be hard to get away from, because if you've done successive exchanges, a string of exchanges like we've done with some of our partnerships, the gains and recapture can be significant. The capital gains tax and recapture can be significant, and it's generally going to be more severe the longer you've held an asset. But if wherever you live, if you have a good real estate agent, and you have a good closer or title or escrow company, they're going to be able to educate you to the basic footsteps of getting an exchange done. And you just want to make sure to get everything done in time. And you want to be aware that if you choose to invest less than all of your equity proceeds, or pull out less than all of your, or replace less than all of your financing, you will be taxed on any shortage or any downward difference between the amount of capital that you have or any financing that you need to secure. And that's called boot, just like footwear. And you're going to be taxed at capital gains rates and or recapture rates. So it pays to fully reinvest and to replace all or more of the financing.
Sure. So you mentioned locate 1 to 3 properties. Would this also be the case regarding partnerships and syndications like that, so people could invest in projects such as yours?
Same rules. Yeah, it doesn't matter if it's, for all intents and purposes, it doesn't matter if it's an individual or a partnership or a corporate holder. I believe publicly traded REITs, use the strategy just as we do, just as mom and pop investors do. And there are some other nuances. There are other sets of rules that you can follow. You can do what's called a concurrent closing, which means have your sale property in escrow or under contract, and have your acquisition property in escrow or under contract, and close them at the same time. And so that's a simultaneous closing. And if you do that, you really, the need of doing the other paperwork for the most part goes away. You should get guidance on that. You should talk to your CPA or tax lawyer or whomever to be sure that a simultaneous closing is going to obviate the need for any and all of the rest of it. You can also simply acquire a property within your designation period. If you sell a property on January 1st and buy a property on February 1st, you've probably met your designation burden. And then there are other ways. There are other parts of the rules that may allow you to designate more than 3 properties, but it also comes with a burden. It can come with a burden of responsibility to close more than one of them.
Sure. Yeah. So as you hold these properties in this REIT and you're buying and sell properties with the 1031 exchange capital, does that trigger a buy and sell event for that person, or how does that piece work?
I'm sorry, Jack. Can you say that one more time, please?
When that person does a 1031 exchange into your REIT or your syndication or partnership, and you then buy and then sell a property that you were holding, does that cause an event for that buyer that they have to go through the whole 1031 exchange process again? Or
it's a great question. If you invested cash with us, and let's just go back to that hypothetical of the $1 million building. Let's say that you and I and a few other people pool $300,000 of capital. We can all be equals. if it's kind of a one for all and all for one approach, or there might be a project sponsor involved, which is the role that we play, that we organize and manage the entirety of the process. But if you're a cash investor, and let's just pretend there are 10 of us and we each put in 30 grand. Your $30,000 is now inside of a partnership. The partnership you own shares in the partnership. You own an interest in the partnership. The partnership owns the property. And so when we sell that property, all 10 of those people certainly have the right, as long as they're all still getting along, to go out and do to acquire another property together, which they often do. And that meets the test of an exchange, again, as long as they manage the details and administrative aspects of it. If for us, if people, it's been great, right? I'm happy to have gotten the economic benefit of it. It felt good. I liked the income. I liked the growth, but I really have other things I want to do with my money. So can I cash out? With us, we always cash out anybody that wants to get out. When we sell a property, it's very easy to identify, to put a bright light on it and put a bright line down and just precisely identify, their allocated share of the equity and any profits that we've made. So, people can get out of that. There are a couple of different, this will get a little more complicated, and I'll try to keep it simple. But the long and the short of it is that you want to minimize tax exposure. You would probably want to have the remaining 9 people collectively buy out the one person, or any one of the 9 people could buy out that person. And that sends that person on their way, keeps the group together. It keeps from having to dissolve your entity. There are also ways to allocate funds out of escrow and distribute funds out so that an investor can get out. We don't favor that approach, but you can do it. And so the answer to your question is, if we're all investors together, yes, we're all doing 1031 exchanges together. And as long as we want to do them, then we're just going down the road. If you and I and one other person went out and bought a property together, and we didn't want to form a partnership, we would most likely go into what's called a tenants in common situation. And so what that means is your name's on title, my name's on title, there's another person involved, and his or her name is on title. And if you look at the grant deed, our names are right there, and it says that you own an undivided interest as a tenant in common with Mark, an undivided interest as a tenant in common with this other person. And it's just terminology that means that we all own real estate together, but we don't own shares at that point. Under the law and under the tax code, an undivided interest is an interest in a piece of real estate. It's not an interest in the partnership. And so if we did the same transaction the same way, and the 3 of us each put in $100,000, and we go downhill and we to the same place. And so the same place is we've now had a sale event that lands us retiring our $675,000 loan and produces for us the benefit of now being conceivably in receipt of $825,000. And so that $825,000 is owned equally by the 3 of us, as long as we went in as equal co-tenants. And I think I can still divide 825 by 3 and come out with 275. So now each of us, instead of having $100,000 of invested capital, we all have $275,000 in invested capital. And what the tenancy in common structure does is it allows anyone in that crossroads to, again, make a decision on what they want to do forward going. And it could be, Jack, that you and I decide that we have something else that we want to do, but our third investor now wants to go a different way, and they want to go out, buy a condo and put it in an Airbnb pool or something. So then you and I turn around, we go back out, we find something. We have $550,000 of invested capital or equity capital, and maybe we top it off with another 100 each, and we now have $750,000 of capital. And so we go out and we find something for somewhere between $2.5 million. We go through the same footsteps. We domicile our funds with an exchange accommodator. We go out and we arrange a purchase of a different asset. We put our money in escrow. We line up our financing. We do our designation within our 45 days. We do our acquisition within another 135 days. And now we're owners of a new property. And let's just say it's valued at $2,250,000, and off we go again. And, and another 5 years goes by or something. And now you have something you want to do, or I have something I want to do. But the value of the property has gone up to $3.5 million. And when we paid $2,250,000, we took out $1.5 million loan. And so now and that's been paid down to maybe $1.4 million. So now we have sale proceeds, gross proceeds at $3.5 million. We pay off our loan. And now we're sitting on, $2.1 million of equity capital. And again, at that point in time, either you or I can choose to do our own thing. We can re-up and go out and do it again. We can go our separate ways. We can come to a sponsor like Hamilton Zanze and invest with Hamilton Zanze. Historically, we've done a lot of tenancy and common structures, but in the last 5 years, we've done a lot of we're doing more Delaware statutory trust structures. They're easier to manage, and they're a more pedestrian structure for investors, because the money just goes into a trust, and everybody goes into the same trust. Nobody's on title. The trust is on title. Whereas in a tenancy and common structure, everybody's on title and everybody's on the loan. And I think that a lot of investors see the Delaware statutory trust as a more conservative structure. So, you could take if we now have $2.1 million of capital, and each one of us has a $1.5 million, and we each have a $700,000 debt replacement burden. We can meet that by reacquiring either on our own or together or with a sponsor. We can put it into a Delaware statutory trust, and your CPA is going to want to make sure that you reinvest all of your capital that you received net of costs from the sale, and that all of that capital goes into the reacquisition of another property. There are some other costs that are considered real estate costs, like brokerage commissions and the like, consulting fees. There are some other costs that can be considered to be real estate purchase costs because they're essential to the transaction. But effectively, you would need to reinvest your $1.1 million in new real estate. And you would need to receive a debt allocation of at least $700,000. And you can upsize both of those numbers. You can add more capital, you can take out more financing, but you usually cannot take those numbers down. If you take those numbers lower, you will generally have tax exposure.
Sure. Wow, this was fantastic, Mark. I really appreciate you giving this. This is like the first time we've actually taken a moment and basically laid it out from beginning to end how a 1031 exchange actually really works. And I appreciate you giving those examples in those situations, because that really kind of makes things more concrete. Again, head over to hamiltonzanze.com. I'll make sure to have that link in the show notes. Mark, this was a great conversation. You're welcome back anytime. I hope you'll take me up on that. I
appreciate it. I hope you'll invite me back. I've appreciated it.
But before I let you go, I typically ask, is there a question you wished I would have asked you today?
Well, I'm going to turn that on you slightly and say, what two questions should a real estate investor ask if they're going to invest with somebody like us, if they're going to invest with a sponsor? Or what are the two biggest risks that you see? And I always feel that you can cover a lot of risks with insurance, by sound vendor selection, by basically good due diligence and good acquisition decision. But there are really two things that require vigilance to manage against in terms of risk. And when people ask me what are the biggest risks of investing in real estate, I always say interest rates, interest rate movement, because when interest rates go up, the value of assets goes down. It's really pretty much that simple. And when interest rates go down, the value of assets go up. And so we've been riding a 40-year wave of falling interest rates, and it's been really good for many of us who have assets. It's propelled values. And so interest rates will always be a risk. And then I think if you're gonna invest on your own, the risk is, are you really suited to it? You really need to understand what's going to go with the real estate. What work, what hours of commitment every month is it going to require, and are you suited to it? And if you're going to invest with a sponsor, you want to do your due diligence on them. You want to make sure they practice what they preach and that they have a great track record and that people that have done business with them. But you also want to make sure that the sponsor has a long-term plan. And so when I meet with investors and people don't ask those questions, I ask those questions for them. I say, you should ask what the biggest risk is, what I think the biggest risks are, and you should ask us about our long-term plan. Because real estate is a long-term investment. And if you're not suited to long-term investment with limitations on liquidity, you should look at other real estate types. But I thought you answered you asked all the right questions.
Well, I appreciate that. Like I said, I really appreciate your time. Again, it is hamiltonzanze.com. I'll make sure to have that link in the show notes. But really, really enjoyed our conversation, Mark. And like I said, I hope you'll come back sometime.
I did too. Thank you. Have me back. I'd love to talk.
You bet.